Welcome to our channel Practical Study Planet. Please subscribe our channel if yet not subscribe it and press bell icon for further updates. Now our lecture 2, Accounting Transactions Treatment. In this chapter we will learn about the nature of transactions, accounting equation, single entry system, double entry system, accounting cycle, rules for debit and credit of an account, journalizing of transaction, ledgering from journals, understanding of trial balance. Let's see nature of transactions. Cash transactions. Any dealing in business with the instant cash in or cash out effect, that is called the cash transaction. For example, we are buying something, some stock, and paying cash same time, that is called the cash transaction. If we are selling and taking cash same time, that is called cash transaction. Anything it is regarding maybe with the cash sales or purchase or expense, whatever we are paying or receiving in terms of the cash, that is called the cash transactions. And the credit transaction, any dealing in business with the intention to pay in future. For example, we are going to buy anything but not paying same time, but we will pay in the future, having the some credit terms with 90 days, after 90 days, 30 days, like that. So it will be the credit transactions. The paper transactions, this transaction automatically generates preparation at every month, so nobody tells about it. It is automatically generated and need to pass the entries at the particular time period. Same way, the depreciation calculated monthly or annually, fined by the government, so it will be automatically generated, but we need to pass the entries for that one. So we learn about now accounting equations. All resources of the business is equal to all sources of the business. Let's suppose this is logically because it's the origin of all accounting system. So what business received is equal to what given to the business, because business is nothing. So what we are an individual is going to start the business, so what owns the business, that is equal to what borrowed to the business. Mean business has liability to pay back to the owners. What assets business has, the business has to pay to the owner. It's not the property of the business. So we will study about in two cases. One will be an investment, all investment by the owner by self, not taking from the outsiders. So if technically we analyze accounting equation, then we can say that while starting a business with worth 5,000, the first accounting equation will be in the mind that before no business, so no claim from business yet. But when started business, then the asset will be the 5,000 and it is equal to the capital owner's equity 5,000, while it started business with the 5,000. If no business started, so the assets of the business is zero and the capital of owner's equity is also zero. There is no business started yet. That is the case 1. Now case 2, the partial investment by the owner and the partial by loan are external. So in this case, maybe the owner has some shortage of the fund and taking loan from outsider, maybe it will be the bank, maybe the external. In this case, the owner by self is saving invests 3,000 and takes loan from the external source, friend or bank, 2,000. Then the accounting equation will be the assets of the business will be the 5,000 and external liability is 2,000 and owner's equity by self invested 3,000. The total it will be the same, the 5,000. All changes in the business move under same accounting equations. For example, let's know to see the illustration. Mr. Jacob started business with the cash 1,000, building 5,000, bought goods for the business worth 50 on cash paid cash for the salary 100 to the employee, sold all goods 50 with the profit 10 on cash. So we will see that accounting treatment solution for that one. What will be that one? Yes, note, on every step both sides balance will be always equal. See here, assets is equal to liabilities plus owner's equity. First transaction, the cash 1000 and building 5000, it is equal to the liability, no external loan over there, so the plus owner's equity 6000. So it will be the total always equal, always at all step it will be the equal. So the next transaction, you see, bought some goods from the cash minus 50 and goods include 50, remaining things the same. The same case, paid salary. So in that case, cash minus 100 more, building will be the same, no effect, goods will be the same, liability, no liability taken from any sides outsider, so it will be the 0. Owner's equity will be the 6000 minus 100, so the expense will be minus from the capital. So the next one, the goods sold with the 10 profit. So the goods costing the 50, but it sold by 10 more, so the cash will be 160 more, building will be the same, goods will be the 50 minus, because all goods having the 50 costing sold, liability, no external sources taken, so the owner's equity now will increase with the profit, because now the 10 more sold, 10 the difference keep for the profit, so it will be added in the owner's equity. So thanks for watching the video. Please like, share, comment and be connected with us for such informative videos.